Module Overview. By the end of this module, you will be able to define and understand the purpose of the income statement, identify and explain the key components of the income statement, analyze the structure and formats used in presenting the income statement, interpret profitability using various margin calculations, distinguish between recurring and non-recurring items in income reporting. What is the income statement? The income statement, also known as the profit and loss statement, P&L, shows a company's financial performance over a specific period, usually quarterly or annually. It reports revenues, expenses, and the resulting profit or loss, enabling stakeholders to assess whether the business is operating efficiently and generating value. Purpose: to track profitability over time, to provide insight into operating efficiency, to help stakeholders assess financial performance and trends. Structure and key components of the income statement. While formats may vary slightly, the typical structure includes the following elements. 1. Revenue, sales or turnover. Total income generated from selling goods or services before any expenses are deducted. Example: a furniture store earns N12,000 in 1 quarter from sales. 2. Cost of goods sold, COGS. The direct cost of producing or purchasing the goods sold. Formula: COGS, opening inventory plus purchases, closing inventory in text, COGS, non-text and opening inventory, plus in-text purchases, on-text closing inventory. Example: cost of producing chairs, buying raw wood, labor for assembly. 3. Gross profit. Gross profit, revenue, COGS, text, gross profit, text, revenue, a text, COGS. It indicates how efficiently a business is producing and selling its core offerings. 4. Operating expenses, OPEX. Includes all expenses not directly tied to production, such as salaries and wages, rent, utilities, marketing and advertising, depreciation. 5. Operating income, EBIT, earnings before interest and taxes. EBIT, gross profit, operating expenses, text, EBIT. Non-text, gross profit. Non-text, operating expenses. EBIT reflects the core profitability from business operations. Non-operating items. This includes interest, income, expense, gains or losses on asset sales, unrealized investment, gains, losses. 7. Taxes. The amount paid to tax authorities based on pre-tax income. 8. Net income, profit after tax. Net income, operating income, interest, taxes, text. Net income. Untext, operating income. Untext, interest. Alt-text, taxes. This is the bottom line, showing the company's overall profitability. Formats of the income statement. There are 2 common formats. A. Single-step income statement. All revenues grouped together. All expenses grouped together. Net income calculated in 1 step. Simple but less detailed. B. Multi-step income statement. Includes intermediate steps, gross profit, operating income, etc. Offers deeper insight into performance. Preferred for financial analysis. Profitability margins and ratios. A. Gross profit margin. Gross profit margin. Gross profit revenue. 100 and text. Gross profit margin. Now left, F bracket text. Gross profit. A text. Revenue or right. L times. 100. B. Operating profit margin. Operating margin. Operating income revenue. 100 direct text. Operating margin. E. Hush left, Jeffrack is just text. Operating income. A text. Revenue. Right. L times. 100. C. Net profit margin. Net margin. Net income revenue. 100 direct text. Net margin. On the left, Nefrac, text, net income, text, revenue, right. L times 100. Example: revenue, N 10,000. COGS, N 4,000. OPEX, N 3,000. Taxes, sh N 500,000. Gross profit, sh N 6,000. Operating income, sh N 3,000. Net income, sas N 2,500. Net profit margin, size 25%. Recurring versus non-recurring items. Recurring items. These occur regularly and include sales revenue, salaries, rent, and utilities. Non-recurring items. Unusual, infrequent transactions like lawsuit settlements, natural disaster losses, one-time restructuring costs, sale of fixed assets. Why it matters. Understanding these helps you evaluate the true, sustainable profitability of a business. Common analysis techniques. Trend analysis. Compare net income over time. Vertical analysis. Express each item as a percent of sales for comparability. Comparative analysis. Compare income statements of different companies. Real life example company XYZ Bakery Nigeria Ltd. Period. Q1 2025. In this course, we will be using item and amount N in our table. 1. Revenue 12,000. 2. COGS 4,500,000. 3. Gross profit 7,500,000. 5. Operating expenses 3,000. 6. Operating income EBIT 4,500,000. 7. Interest expense 300,000. 8. Taxes 900,000. Net income 300,000. Review summary. The income statement tracks performance over a period using revenues and expenses. Key figures include gross profit, operating income, and net income. Profit margins help assess efficiency and profitability. Non-recurring items can distort the true picture if not analyzed carefully. Financial analysts use both formats of the income statement, depending on the depth of analysis required.